Only last week, Altria Group, stock ticker MO, announced that it's increasing dividends by 4.3% to $0.98 per share. This means that the annual dividend is now $3.92 per share, putting the current forward yield at about 8.8%. Does this mean it's time to buy Altria? Maybe. But let's take a deeper look. Altria is one of the biggest tobacco companies globally, a dividend investor favorite. But it's controversial and has underperformed the S&P 500 over the last 1, 3, 5, and 10 years, even with dividends included. So why do people keep buying Altria Group? What's the whole deal with this dividend stock? Surprisingly, it's the dividend. It's massive, one of the highest in the American stock market, sitting at 8.81%. Altria Group is also dividend king, consistently increasing dividends every year for 53 years. In fact, Altria is the dividend king with the highest yield. There is something very appealing about a company that shows consistency with dividend payments. A lot of dividend investors are looking for reliable dividend growth, year in and year out. Altria has shown that it can do this. The problem is that the dividend growth rate is slowing down. It was 7.9% over the last 10 years, going down to just 3.8% over the last 3 years. Like I said at the start, Altria did raise its dividend last week by 4.3%, which was above expectations. Can they keep it up though? I guess we'll see next year, but investors are expecting about 2.9% dividend increases going forward. Altria Group do have a pretty high payout ratio, although it is historically normal for the company. Typically, it would be a red flag. In fact, Seeking Alpha is flagging it as a red flag. The thing is, Altria's business model is a bit different. They have high margins and slow but steady growth, so this is a problem, but it's not that bad. The management hasn't shared anything specific about their dividend policy, but to me it looks like the dividend is relatively safe. As long as the earnings don't suffer a big unexpected drop, Altria can continue making dividend investors happy. Relative safety, consistency, growth, high yield, it's all there. Can Altria give you a good capital return though? Is Altria currently undervalued in terms of its stock price? There are two ways we can value the company. One is relative valuation, which is done by comparing it to other companies in the sector and also Altria's historical valuation. The second is intrinsic, so basically the value of the company itself, the cash flows it can generate, the dividend it pays. Generally, Altria is cheap when compared to the rest of the industry and its own historical valuation. Price to earnings growth, price to cash flow. These show how a company is priced based on how much profit and cash flow it brings. Typically, these are more important than other valuation metrics. Investors care about them a lot more. However, Altria has negative equity and that's a red flag. This skews the price to book metrics. The price to sales is not looking great either, although Altria has incredibly high profitability and margins, so this isn't as much of a problem. The intrinsic value of Altria is a bit mixed though. I used 3 different valuation models to estimate the fair stock price. A simple EPS extrapolation and discounting, the Gordon Growth model that is used to value dividend growth companies, and finally, the most popular method, the discounted cash flow model. The Gordon Growth model looks way off, and to be honest, it has limitations. It only looks at dividend growth and expected rate of return, so it ignores a lot of other factors. That's why we also look at the EPS valuation and the discounted cash flow models. The problem here is that the results are a bit mixed. Valuation models rely a lot on forecasting, assumptions, estimations. These can vary a lot, so that's why you want to have a good margin of safety. Here, we don't really have it. The current price is just 5% under the discounted cash flow value and about 13% than my EPS valuation. That doesn't give me enough confidence, personally. A good margin of safety would be something like 30% or more, ideally 50%. That way, even if you are wrong, the forecasting and estimations are off, your investment would still be relatively safe. Basically, I'm looking for a price of at least $60 here from all 3 valuation models, given the current price of $44.52, and I don't have it. So, what can we take away from all of this? Well, Altria has a steady dividend, and the management is keen on continuing the dividend growth record. That's why if you're only after the dividend, Altria can look very appealing. However, I'm not sure about the stock price. Altria is fairly valued at best. I have a feeling Altria is a value trap, a dividend trap. It has consistently done worse than the S&P over the last 10 years. Plus, the tobacco industry is changing. Less people smoke cigarettes, and there is a general trend away from tobacco. There are new opportunities in the market, but this requires a change in the business model, and that means extra uncertainty. Altria has IQOS and other new, smoke-free products which are doing okay, but there's also legal problems like the situation with Juul. Basically, in the best case scenario, I think Altria will do okay. Just okay. On the other hand, there is a lot of room for things to go wrong. I mentioned the high debt too, so that's an extra added risk. Now, I have some shares in Altria myself, but it's a small position, somewhere about $272.6. I think you may get away with some short-term positions if you buy the dips, but I'm not convinced that a long-term investment in Altria Group is viable. That's what I think. What do you think? Is my take on Altria completely off? Are you bullish or not? Let me know in the comments below, leave a like if you enjoyed this, and I'll see you again in the next one.